Hi, everyone, and welcome to chapter number 8. This is about the accounting for the intangibles. Accounting for the intangibles is normally deal with International Accounting Standard number 38. And in Australia, they use 100 with this, so it's 138 International Standard Board for Australia. Now, what is the objectives for this lecture? The objectives are very clear. We try to understand a little bit more about intangibles, how they are any different with the tangibles. Try to understand the expenditure which we spend on the intangible. Should we make them a part of our asset or should we make them a part of the profit loss account? Then try to understand when the expenditure of the asset can be expensed out. Try to understand the intangible, either whether we need to amortize them or we need to impair them. So there are two schools of thought. That one of the school of thought say, hey, you need to amortize the assets when they are intangible, because as the time passes, they lose its value. But another school of thought say, no, you have to recognize that on kind of a like annual basis and try to impair that rather than amortize that throughout the life. Another thought is try to understand the accounts for research and development, R&D expenses. A little bit criticism is given in the end. The last point which we will do is the treatment for the goodwill. Whether the goodwill is internally generated or if the goodwill is acquired, what should be the treatment for both of these intangible assets? Now, what's the definition of intangible? Definition of intangible means a non-monetary asset without a physical substance. Means you cannot touch them. They don't have a physical substance. So that's fall under intangibles. Some of the examples they have mentioned, like patent, goodwill, copyright, and all these assets are considered as intangible examples for the different categories. Next slide is about the identification of intangible. The identification of intangible only happen when we often classify as there are two categories. Either they are identifiable as a intangible or they are unidentifiable as a intangible. So what's the difference? The identify is the one which is shown into your books in your financial statement, and that is called identify tangible assets. Examples are more or less same, which I just discussed now. What is the unidentified intangible assets? Those assets which we internally generated. Like, for example, we internally generate goodwill. We do not recognize it as an intangible. We internally generate any other asset because it's internally generated and we don't know its market value unless we don't sell them our company. So therefore, we cannot identify this as our intangible asset. Is considered as unidentified tangible assets. So next slides is about the unidentified tangible assets that cannot be separately sold. Like, for example, your company has a very nice goodwill and you know about it. And you know in future, whenever I'm going to sell, I will get benefit from it. So there will be a future inflow. But the problem is that you cannot just sell goodwill and remain the whole business. So your business is sold with a goodwill. So they are not separable. So you cannot separate goodwill with a business. So cannot goodwill be sold separately. Therefore, they are called unidentified intangible assets. Although you know the value of this goodwill is very high, hence that is called that's why you cannot sell that, but you cannot sell that as separately. So therefore, it's unidentified intangible assets. We will do some of the examples in upcoming slides. Like one of the written example for that intangible is this, where they have something goodwill, they have a patent, they have a customer contract, some software license, some other assets. They are all the part of intangible assets. And now some of those they allow amortization, some of those they allow impairment and amortization. So we will discuss later on which assets we can apply impairment and which asset we can apply amortization and which asset we can apply both. So these are a little bit discussion in upcoming slides. So this slide is about which intangible assets can you recognize and include in the financial statement. Those assets which you acquire, which you buy from somebody, you can write down into your financial position. You cannot write down those assets which you internally generated. Like Goodwill is one of the example. So these cannot be identified in a financial statement. There is one exception to this general rule, that internally generated development expenditure that we can recognize in our books, means in our financial statement. However, but there some terms and condition apply. We will discuss that in the later on slides. So next is about which of the intangible assets can be recognized. Some of the examples they have give how and what should be the price of that intangible asset. Since this accounting standard is a mimicry from International Accounting Standard number 16, property, plant, and equipment. So the way you identify the property, plant, and equipment is the same way you identify the intangible assets, where you have to apply all the costs that includes legal fees, taxation, maybe the installation of software also. So these all are a part of the cost of the intangible asset. However, there is one rule which is quite clear. If you recognize something as an expense, you cannot later on identify this as a part of the asset. So you have to bear in your mind that once you identify something as an expense and expense out in profit loss, you cannot identify later on as a part of an asset. That's a little bit discussion on this slide. Now the summary. So every 3 and 4 slides there's a slide for the summary. The general rule is that which apply to most of the intangible is that asset is that this is the same definition as per property, plant, and equipment, that there is a future economic benefit flow to the entity. Cost can be measured reliably and company has a control on them. However, these are some specific intangible assets that are called not internally generated except development expenses. Like all those expenses, all those intangible which are internally generated, they are not a part of this recognition of intangibles. So we need to be very careful while we are identifying some asset as an intangible. As in research and development, R&D is the only intangible which is internally generated and you can recognize it. Apart from that, all the internally generated intangible cannot be recognized. So this slide is kind of a like summary of last 4 or 5 slides. So what is the initial basis of measurement of intangible? So how are you going to measure this intangible expenses? So expenditure on the intangible that is initially recognized as an expense, later on you cannot be a part of the asset. So this is very much clear. There is an example in your book 8.1. Please go ahead and read that example. It's a very useful that express that once you identify something as an expense, you cannot identify that later on as a part of the asset. Now the upcoming slides is about amortization. So can we recognize amortization on the asset? Yes, we can recognize amortization on the asset if we believe that the asset loses its value every year. But you need a solid reason to amortize an asset. Although the rules of amortization is quite similar, like the rules of depreciation, like the asset value less scrap value divided by useful life, straight line method will be applied. However, you have to identify that, hey, we have checked its value. Every year the amortization have to be applied. For example, you buy another company or a subsidiary and you find they have their value is more in the market than what you have paid. So the remaining difference is kind of like a goodwill of that company. So that goodwill become an intangible asset because this time you have buy that asset. So in future, you believe that once you buy, every year they are reducing the value and you have to show that the fair market value is reducing every year. So you provide some evidence. If that evidence is okay, then they will allow you to apply amortization unless or until you hold that business. For example, you are intent to hold that business for next 10 years. So you have to divide the goodwill divided by 10, and whatever the amount will be, that will be the amortization for the assets. So over the period, the asset is expected to lose its value. So maybe there's something like you have to produce something which is in number of productions, like number of units. For example, you have a software license, after 100,000 license of this product, then this will be expired. So the license you have bought, after 100,000 units produced, it will expire. So every year I'm using 20,000 units, I'm producing 20,000 units. So I can amortize it by 20,000 every year. So it differs from one intangible to another intangible. Some intangible works where they got amortized based on number of units produced. Some intangibles are reducing its value every year with a straight line method. So these two methods are quite renowned, but in case you do not know which method to apply, then the accounting standard IAS 38 say that you can apply straight line method. So in case of you do not know which method to use. So there is a little bit discussion on how the IAS talk about the residual value of the intangible. With a finite life is generally considered as 0. So we consider that there is no residual value. Why we are discussing about the residual value? Because we just discussed about the straight line method. So we know the straight line method is cost minus residual value divided by useful life. Since we don't know, if in case we do not know the residual value, so it's considered as 0 normally in intangible cases. So in intangible cases, normally cost divided by useful life rather than reducing it by the residual value. They say residual value is considered as 0, but there are two exceptions to this general rule. One is committed by the third party. They say, hey, you use this license and you produce 100,000 units. After you produce it, you give us back, and what we do, we will sell in the market, and we will buy that for you for 10,000 ringgit. So you already know what is the residual value. And then there is the concept which keep on coming in this accounting standard is about the active market. So if there's an active market for the asset, which is very, very, very rare to happen, active market is basically that it is a term where the trade are homogeneous, like there is a willingness of the buyer and the seller that can normally be found, and the prices are publicly available. So that is called active market. So if there is an active market, that's another case where we can consider a residual value, that after a useful life of the asset, there is some scrap value available for this asset. So that's another case where we can consider the residual value has some price rather than 0. Now, there is some discussion on general amortization rules, which is continuing this one, that if the asset has been indefinite useful life, so we do not know how much life it is and they are indefinite, so there is no requirement for amortization. So in this case, you don't know the useful life, so you cannot amortize. But there is one thing that instead of the asset should be subject to the impairment test. What is impairment test? We discuss later on, but I give you a little bit example. You have already studied the impairment in FA1 and FA2. So instead, the asset should be subject to the impairment test. So we have to check its value reduction every year. If your market value is less than the carrying book value, that's called impairment of the asset. So maybe you are keeping this asset in less than whatever available in the market. So you cannot amortize that one, but you have to do the testing for the impairment every year or on the regular basis after every 6 months. Again, the summary is provided in this slide. They say amortization or depreciation for the asset is same rules as per depreciation of property, plant, and equipment. You can use straight line method, you can use number of production method. But there's two different situations in intangible. If the intangible has a limited useful life, then we will amortize. Yes, amortization only happens when we know the value, what is the useful life, and then that's the denominator. So if we do not know, then there is no amortization. Instead, we will do the impairment test every year. So this is a little bit discussion on impairment test. So For the few slides, we will discuss about the impairment test it's later on, and I will give you one of the example as well. Then we'll discuss about the revaluation of the intangibles. So revaluation reserve is the same revaluation which we do for the tangibles. Like we will check whether or not the fair market value is more than the carrying book. If the fair market value is more than the carrying value of our intangible asset, then we consider it as a revaluation reserve. But this is very, 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 very uncommon, that are very rare, that there is active market, which I defined earlier, available for the asset you are carrying. So maybe you are carrying an asset for which there is no market, or there is some market, but very few people wants to buy it. And because of its unique nature, it is very hard to find active market in the intangible. So revaluation is nearly out of question for intangible, but it might possible that there is an active buyer who wants to buy that after the useful life, and he's paying you more than the carrying value. So that's considered as the revaluation of the intangible asset. There is an example for 8.4, which discusses about the revaluation of asset. When the revaluation occurs, it must be for the fair value of the asset. Fair value is basically the price which you will get if you sell that asset in the market or transfer to pay a liability. So if you have a loan and you transfer that asset by the end of its useful life or during the life of the asset, and it is more than, your liability is more than the carrying value of this intangible asset, so we will assume that it is considered as revaluation has been done, and we need to note down the revaluation of the entry. In Australia, there is one exception rule that revaluation is not allowed for the goodwill in Australia. So either whether it is internally generated goodwill or the externally acquired goodwill, because we already know that goodwill is only recognized when that is externally acquired, not the internally generated assets. So in that particular case, we are not allowed to do the revaluation for the assets because there is no revaluation available for the goodwill, which we acquire even from the other business. So if we acquire from the other business and the goodwill is 120,000, maybe next year it increase. Next year it might increase, or maybe there's some difference occur because maybe you're handling the business too much efficiently. So the valuation of the goodwill increase. Still, it is internally generated based on the efficiency of your management. So therefore, we cannot recognize that revaluation. For any other asset, revaluation might occur. Again, there is the need of active market. They will allow you to have this revaluation. So a little bit summary about the revaluation. So subsequent measurement of the intangible can be happen. It can be happen at fair market value if we believe there is a active market available for the asset. And we can do the furthermore measurement of the asset, right? We evaluate that at the cost, but the condition is very clear that if it's subject to the amortization, and amortization is subject to the useful life. So if the useful life is definite, then we can do the amortization. If it is indefinite, so there is no amortization. So this condition is applied in this particular subsequent measurement of intangible. So that is pretty much it from this lecture. Now I will meet you in the next lecture slide. Until there, take care. Bye-bye.